A manic Monday for world markets. John, I'm going to start with you. We have oil in crisis. Yields are plummeting. Stocks are plummeting. What are you doing with a market like this right now?
You got to be in defensive assets because with the coronavirus already depressing growth expectations and this supply shock coming from OPEC, a supply shock on the negative side, you're going to have markets pricing in recession. And recession means zero rates from the Fed. That's why you got to own treasuries. And it means a lot of unwinding of carry trades. This is why you've got to own the yen.
Terry, I know you as a fundamental guy, study earnings and profits, but what do you do in an environment like this when you see good, fundamentally strong companies getting walloped in the pre-market?
Yeah, first of all, Brian, I'm not sure you have to do anything right away. I think we need to digest this, see how the market trades this morning. But if you're a fundamental investor, as we are at CJ Lawrence, you're looking at opportunities. You're looking to see what is trading off that shouldn't be, what's benefiting from fundamental drivers and changes in the economy over long-term trends, and that's where you're repositioning portfolios to.
Andy, it seems like the perfect storm for volatility in this market right now. People are wondering, do I buy on the dip? I'd argue this is more than a dip. Is it best for just the average investor watching all of this to stay on the sidelines right now?
Yeah, I think so. I mean, look, these are the times that try investors' souls. There's no doubt about it. But, I mean, what are you going to do right now? Sell and then it's going to go down more? Do you need the cash for college tuition this semester? Those are sort of the typical questions. Do you have some cash that you want to put to use, put to work maybe over the next week or so? I mean, because I don't think things are turning up anytime soon. I really don't. It kind of reminds me a little bit, you guys, of 9/11. And I don't mean to exaggerate it, but here in New York, for instance, because you're looking at a market that's under stress, and then you also have questions about personal safety and health.
Yes.
So we haven't had sort of both of those things come together at one time in a long time. And, you know, it's actually creating a lot of dislocation and uncertainty. And, you know, I understand the fear that's there.
Jared, over to you.
Yeah, lots of carnage around the world here. In Asia, not as bad as things have gotten in the West, but we do have the Shanghai down 3%, the Nikkei down 5%. In Europe, most of these markets down more than 7%. The DAX, the CAC 40, and the FTSE all down more than 7%. S&P 500 futures here are stuck at 4.89%. That is a circuit breaker. That is a lock limit low. They cannot trade any lower than that. That's the overnight price action. They've been stuck there since 9:30 last night, and we can take a look at what some of the commodities are doing. Now, here's WTI crude down 21%, and this is what's happened since midnight. We can see we're off the lows here, actually hit a 27 handle. Haven't seen a price that low since we had that huge plunge in February of 2016. We got down to 26. We might expect to see some reaction off of it, but this is going to take a long time to digest for the markets. We have a situation where many of these markets are simply broken.
John, you mentioned a moment ago this market looks to be pricing in a global recession. What, if anything, should policymakers, should governments around the world be doing in response?
So they should be doing some unique things because it's a unique crisis. It's a recession which is partly caused by a public health issue, which is the coronavirus, and it's being exacerbated by this geopolitical issue around how the oil supply is going to be managed. So you got to have a lot of components to this. The most important issue is all the containment measures around the virus. The second is the easing by central banks in order to prevent credit markets from really amplifying the stress that's coming through in equities. And the third is you need to see fiscal stimulus in those countries that can do it. And all of this is happening in the background. It's just that it's going to take time for this to really show some fruits in terms of containing infection rates, causing some macro data to stabilize. So I feel like you're going to have another couple of months of turbulence, even if you are going to avoid a recession.
A couple of months of turbulence. Here we have a new trading week beginning at the New York Stock Exchange and the NASDAQ. We saw those stock futures down about 5% across the board. The Dow Industrials starting the day. Wow, I don't remember seeing this probably in at least a couple since 9/11, Andy. Yeah. The Dow starting the day down nearly 6%. Had we been down more than 7%, those circuit breakers would have hit. Here are the headlines making the first trade front page this morning. First up, deaths and the number infected with the coronavirus are surging in Italy. That country is now implementing a massive quarantine to stop the spread of the virus. And as markets plunge here and around the world, yields on the 10-year T-note falling below 5%. That is a new record low. And of course, oil prices plummeting this morning. Crude at one point losing about a third of its value as Saudi Arabia battles Russia in an oil price war.
Terry, what do you need to see from, I guess, fiscal policymakers, even the Fed, that you'll say, you know what, now's the time to get more aggressive in this market? I mean, we have Dow now down about over 1,700 points.
Yeah, Brian, I think the Federal Reserve in the U.S. is doing that. I think central bankers around the world will follow. And I think we're going to get some fiscal stimulus here in the U.S. So I think the policymakers are doing or about to do all they can. But I think the headlines are going to be negative for a while. So what we're going to watch for is to see when stocks stop going down on negative headlines. There were a couple of notes out from China this morning suggesting that they were seeing fewer than 100 new cases of coronavirus over the last few days. That's encouraging. China is obviously very different than the U.S. and the Western world in terms of their ability to contain it and shut down cities. But we're going to have to see peak virus here in the U.S. and around the globe before the headlines start getting better. But if you start to think out, if China took 3 months to try to contain this virus, and if we take 6 months and a recessionary period, 2 bad quarters, as we start to get towards the summer and start to look, virus has peaked, 2020 is a wipeout in terms of earnings growth, investors start to look towards 2021. And I think 2021 could be a very interesting setup. We're seeing multiples in the market compress now. We're seeing earnings hanging in there for 2021. We'll see some deferred purchases, deferred demand going to 2021. As you get into the summer, things could get quite interesting for the U.S. market.
We better get there quick.
We are very, very close to having trading being halted for the S&P 500, a drop of 7%, and we're right there. The S&P now down 6.87%. If it were to fall 7%, trading would be halted, and this is put in place so that sort of, I guess, Andy, the panic button doesn't get pressed if it hasn't been pressed already, right? Investors would have a moment to sort of rethink things.
Yeah, I mean, just what to pick up on what Terry was saying, 2020 may be a lost year at this point, but just batten down the hatches, hunker down. There's so many little facets. We're following the news real time. I mean, Ted Cruz self-quarantining himself. What about Exxon here? That stock is now yielding like 8-9%. Right. How safe is that dividend? Is Exxon going to have a cash crunch? Are they going to have to borrow to keep the dividend secure? What about Chevron? What about Occidental Petroleum? That stock is under a tremendous amount of pressure. Bond yields, what does that do to valuations of stocks? But even more than that, are we going to have negative yields? I mean, the 10's like 0.3% right now. So there's so many questions, and I totally agree with Terry and John about fiscal stimulus. I think that governments around the world are really going to have to resort to that. And, because the central bankers have run out of ammo. Mm-hmm. So there's so many things at play here, but, keep calm and carry on is something we all really need to keep in mind as well.
John, you're calling this, I read your note this morning, calling this a gamma event. What does that exactly mean?
Well, it just means that you're seeing a huge surge in volatility because of the tremendous uncertainty around the economic outlook. So I just don't think that's going to be a situation that resolves itself until you see a lot more liquidations in terms of investor positioning and much more success in terms of containing the virus.
And John, what are you seeing with the yen? Is the yen a true safe haven in this type of environment?
Well, think of it not so much as safe, because Japan is hardly a safe economy. Just think of it as a funding leg of a lot of investments. And when those investments are unwound, as they always are in recessions, the funding leg is bought back. And that's
John, I'm going to stop you just for a moment. I apologize. Trading has been halted. We want to get down to Inez Ferre down at the floor of the New York Stock Exchange. Inez, what do you know?
Yeah, we just are seeing right now 27.64. That was the level that traders were watching for. That would be a 7% decline. That kicks in the first circuit breaker for 15 minutes, and that's what happened right now. We're at 27.64.21. So the circuit breaker has kicked in. We are halted for trading right now. Just talking to the traders here earlier, they were saying this is like a panic selling. And one of the traders was telling me the 10-year Treasury, watch that 10-year Treasury. He's saying that the government should sell more Treasuries in order to boost up the yield. It's trading below 0.5%. He's saying a lot of the crisis of what we're seeing is in the bond market. Alexis, Brian?
Terry, you've been doing this a long time. What does this remind you of, if anything, or is this just a very unique situation and time in our market history?
Yeah, it's unique in my view, Alexis, just given what's taken place over the last couple of days. This happened very quickly, right? So in the crisis of 2007, 2008, 2009, the market took a year to kind of clear itself. Go back 18 months, in late 2018, we had a 20% sell-off in the S&P 500. That happened between early October and Christmas Eve. And then the market started to recover. This sell-off has happened in a matter of days, and that's quite unique. So, look, I think what we're seeing today, selling begets selling, right? We're hitting triggers. Electronic programs are kicking in, margin calls are kicking in, so the selling will be exacerbated, and we're going to have to see our way through this until we kind of see where the dust settles and figure out what to do next.
All right, let's head to the CME in Chicago, where John Caruso of RJO Futures is standing by. Good to see you here, John. Your thoughts on the market sell-off this morning?
Yeah, I'll tell you what. I mean, this kind of caught a lot of people by surprise. Obviously, you had the Russia and OPEC fallout late last week, and then it only exasperated over the weekend, where the Saudis actually came in and said that they were actually going to raise oil production, which we're already having demand destruction in that industry right now. And now they're going to increase supply. You're seeing the market absolutely plummet here this morning. I actually think it's funny. The last time I was on here, we were talking about how high could oil prices go following the U.S.-Iran conflict. That was only about 7-8 weeks ago. And here we are talking about how low can prices go from here.
All right. By the way, the market is going to resume trading at around 9:49. We are hearing. Andy, you wanted to add something?
Yeah, it's just interesting. You know, I mean, I think we're all sort of wondering what happens at that 15-minute mark.
Right.
I mean, is everyone like all bunched up and like, man, when I open up again, I'm out? You know, are we going to see the market crater from there? Or are people going to say, okay, I feel good now, we'll get some buyers in? I don't think the latter scenario is going to happen today. I think we're going to see more weakness come after those restrictions are lifted. But again, you know, what does that mean in the long run? Probably not so much. I mean, think about Warren Buffett and all those old lessons about the U.S. economy being strong, and in fact, the global economy strong over time.
Right.
But this is a weak time, not a strong time.
Jared, over to you.
Yeah, we're looking at the NASDAQ 100 heat map. The mega cap tech names just getting hammered here. Apple, Alphabet, Facebook, Amazon, all off more than 7%. Microsoft nearly there. Of course, trading is halted right now. We should resume in approximately 10 minutes. We can also take a look at the Dow. We have financials under a tremendous amount of pressure as the yield curve is just collapsing. We have the entire yield curve under 1% for the first time ever. So here we see some of those names. Johnson & Johnson down 4%, United Health down 7%. That was a relative source of strength last week, was the healthcare names, but everything just taken to the woodshed today. And here are the sectors that we're looking at. Staples and utilities, relative outperformers, along with healthcare and real estate. So definitely a defensive setup. To the downside, energy down 19%. I don't think I've ever seen that before. Financials down 9%. The industrials are down 7.7%. And then if we take a look at some of the other markets that are moving here, here's a 10-year T-note yield trading at 0.46%, down 25 basis points. Simply incredible. We can also take a look at crude oil. That was down about 21% last I looked. Here we go, trading with a 32 handle. How low can oil prices go? Well, they tend to overshoot. So who's to say how low oil prices can go in the coming days?
Jared, our market here is halted, but can you bring up the world map for a moment? Because I'm curious to see what markets are doing that are up and running at the moment in response to the fact that we've stopped trading.
Sure thing. Well, let's take a look at the FTSE. So London was down just under 8% when we looked at this before the open. Now we can see it's sunk even lower. So this is basically what's happened since our open, and it is trading lower right now. We can also take a look at the DAX, for instance. That's now about down 8%, and that is hitting session lows as we speak right now. So just around the world, we can see even though our markets are halted right now, other markets trading lower.
John, let's get you back into the mix here. Two-part question. One, a lot of these European markets are approaching bear market territory. John Norman, bear market territory. Do you see any sense of a potential bottom forming? And then secondarily, market's bigger picture here. Is this the start of some form of a rolling financial crisis?
So I think the closest sign to a bottom would be if equity markets went down probably another 10% from where they are now. That means markets are pricing in a recession. And if you believe that fundamentally we're not going to get a contraction in the U.S. economy for several quarters, which is what a proper recession is, then you'd say there's value. But we're not there yet in terms of the downside. In terms of this being a rolling financial crisis, I think you could say that in the sense that you definitely have a rolling epidemic. The rolling epidemic is causing a series of rolling contractions in economies, and that's creating the credit stress. So there is a domino effect to this. The core issue is really a public policy one. I think that's why you really have to watch the public policy response, what happens to infection rates, to call it into this, because that's really what's going to drive things much more so than what the oil price is doing.
You know, Terry, the Fed increased short-term funding this morning before the markets opened. They don't have a lot of tools left in the toolbox here to fight what we're seeing in the markets. What would you expect the Fed to do? I mean, we know their meeting is March 18th. What do you think the next move is from the U.S. Federal Reserve? I think they'll cut rates again. I think they'll do everything they can. I think the Fed wants to avoid any type of systemic issues that we touched on. But there's only so much they can do. The first part of the challenge this morning is coronavirus related. The second part is the energy complex. Regarding the first part, it's going to take its course, and whatever the Fed throws at it is not going to help us find peak coronavirus. So I think time is going to help. Unfortunately, that's a tough thing for people to hear when markets are panicking, but we'll get through this. And when you think about where the market is, we're kind of getting back to where we were last March. Right? We haven't given up multi-year gains yet. The circuit breakers are kicking in. It feels horrible today and probably will for another couple of days and weeks. But we will find a bottom, and then we'll start to focus on fundamentals again, and the market will regain its footing. And when we find that bottom, do we shoot right back up? Are we going to stumble along the way? What might that even look like? Yeah, it could be a quick snapback. I mean, because there's still cash on the sideline. When you think about the backdrop of the U.S. consumer, of U.S. corporations, they're still very healthy. Savings rates are high for U.S. consumers. Corporate balance sheets are strong. So if we have a two-quarter dislocation, most consumers and most companies can weather that. If you add on top of that some fiscal stimulus, some relief to small businesses from the federal government, we could see our way through this. And as the bad news starts to abate regarding the virus, the market can regain a footing, starts to look forward. It's a discounting mechanism. And the setup for 2021, as I mentioned earlier, could be bright. You know what's interesting, Terry, when we're talking about fiscal stimulus, what a great place to stimulate the economy would be healthcare. So in other words, we get a massive spending bill to combat the coronavirus, which in itself might be stimulative to the economy and would be sort of a twofer. Yeah. You got that. You also have, tax relief for small businesses. You might see QE2, QE3, QE4 from the Fed, but the interest rate side, there's not a whole lot of ammo there. Andy, is part of the problem here with the market that the administration doesn't appear to have the coronavirus situation under control? Yeah, I mean, obviously Washington's under fire, and then it becomes partisan to a degree. A lot of times people on one side of the aisle will really point fingers at the other side. Governments always tend to be not prepared for these kinds of things, right? I mean, one government that's actually pretty prepared is Vietnam. And they're very good at fighting these things, but, that's a different political system. China has a different political system, and they were still, behind the eight ball when it came to fighting this thing initially. Right now, for instance, things are very strict. I was talking to a friend in Shenzhen over the weekend, and he said when he was going to a restaurant, he scanned his phone. It showed where he had been over the past 14 days. Then they took his temperature. Then they let him in the restaurant. Wow. Now, you may not like that, but that's a pretty effective way of combating, an epidemic. So you can see the trade-offs when it comes to society and economics and healthcare. John Caruso over at the CME, this question is for you. One analyst this morning saying Russia punched investors in the face, the fact that they're not playing along with Saudi Arabia, and now we are seeing this price war in the oil pits. What does this mean for the debt market, and are we going to start seeing a bunch of oil companies begin to default and go out of business? Yeah, to be honest with you, I mean, that's what a lot of people, I feel like that's a very undervalued story right now. You got to remember there's 10 million jobs in the U.S. fracking industry, and with oil falling below $45 a barrel, which is pretty much their cost of production, who knows how long we're going to stay down here at these levels. I really feel that Russia is, they believe that they can thrive in a low oil environment and potentially put some pretty stiff competition out of business. John, interesting note out last night from Goldman Sachs suggesting that oil prices could hit $20 a barrel, but embedded in that piece that they put out suggested we could hit 1998, 1999 levels, maybe around $10 a barrel. Where do you see it? I'll tell you what, I'm going to take it day by day. The next downside target we have was the 2016 lows at 26.10. There's going to be some psychological support at 25 and then again at 22 to 20. I'm just going to take it day by day and just, kind of keep my ear to the ground in any new developments between Russia and OPEC. John Caruso, not John Caruso, John Norman, are you there? I hope you're there. Wanted to talk to you about this slide in oil because normally, right, this is good news for consumers. It's good news for the airline industry with oil being so low. Is that just not going to work this time, given the backdrop of the coronavirus?
So it's going to work eventually. I just don't think it matters over the next couple of months because the pace of the decline is so large. The focus is much more around the credit stress it creates in the U.S. economy and a lot of the balance of payment stress it creates in a number of emerging market economies. So it's more the speed of the decline that's highly problematic. It doesn't really give the consumer lift a chance to really dominate the sentiment right now. It's much more about the stress it creates in U.S. credit and in a lot of the emerging markets.
John Norman, what's a safe haven look like in this type of environment? In your note, you mentioned cryptocurrencies, but is that a place you really want to be?
Absolutely not. I mean, they've shown zero ability to hedge drawdowns in equity markets. I think it's much more the basic, uncreative, vanilla stuff. So it's treasuries because the Fed could be easing to zero, which means that's a reasonable target for 10-year U.S. And it's the yen and the dollar because those are the funding currencies that have been used over the past year to invest in EM. And as the EM exposure is unwound, that's going to drive up the dollar versus a lot of currencies and the yen versus the U.S. dollar.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.